For newer traders and even for more experienced traders, it's really tough to trade volatility and get a true grasp on it, particularly the volatility ETNs. Joining me from the floor of the CME is Senior Instructor for the CBOE Options Institute, Russell Rhoads. Russell, let's explain first a little bit of basic concepts on the VIX and why day traders in particular have a hard time trading it using tactical analysis, because it's a stat, it's not a stock.
No, absolutely not. Actually, VIX has an inverse relationship on a day-to-day basis relative to the S&P 500, and it's got that moniker, the fear index, and there's something to be said to that. So you can actually kind of gauge even intraday with VIX an idea of what's going on in the S&P 500 as far as an emotional basis. And sometimes if VIX stops going down before the S&P 500 seems to have topped out during the day, it actually can signal a reversal even over the short term, not just over the long term.
So moving along to the volatility ETNs, these are exchange traded notes. These are not like regular ETFs. And traders have a hard time understanding, well, if it's supposed to track the VIX and it's moving inverse, why is that happening? And why are there products like the VXX, the UVXY, that just continually go down? The VXX, for example, is down 99% since inception.
Well, VXX is probably one of the most misunderstood products out there. There are lots of misperceptions about it. A lot of individuals that just have started taking a look at VIX for the first time think VXX and VIX are the same thing. VXX is actually, as you mentioned, an exchange-traded note, which differs some from an exchange-traded fund. But VXX actually follows a strategy, and the strategy that VXX follows is a weighted strategy between the front 2-month VIX futures contracts. When you're buying VXX, you're not buying VIX, you're actually buying a portfolio that's got a weighting in the front 2 months VIX futures contracts that's consistently shooting for a 30-day weighting. So you're continuously having the portfolio sell out some front month futures and buy some back month futures. So now the way the way VIX futures pricing works, more often than not, the front month is at a discount to the second month, so you're seeing this contango that is pulling some value out of the VXX from day to day.
So what about, when does it make more sense to trade this? When it's contango backward dated, or is it just good really for short term, maybe day, maybe swing trade type of strategy?
Well, absolutely. VXX is not a good long-term hold. VXX, since it went public in early 2009, or since it was introduced to the public in early 2009, is down tremendously, and there's no secret to that. You can see that on a chart. But you have to approach buying VXX the same way that you would go about, that you would approach buying maybe an out-of-the-money call option on volatility. You would expect from day to day, if the underlying doesn't move up, that you would have some time decay. And VXX basically has a little bit of time decay from day to day.
So what makes more sense to wrap this all up? Since traders are really starting to back away from some of these volatility ETNs, it almost sounds scary for the retail investor to either trade options on VIX or SPX or futures. What would be a good hedge against a relatively long portfolio?
Well, a good short-term hedge, VXX does what it's supposed to do when it's supposed to do it. And I'm stealing that from a really smart guy in research at CBOE. I thought it was a great comment, and he made that comment back in August of 2011 when we had VIX go from, I believe, 32 to 48 in a single day when the S&P 500 dropped 6%. VXX performed quite well at that time. The issue over the last couple of years is that the VIX has been relatively low, and VIX futures prices have been in contango for almost 2 years with just a few exceptions. Now, recently I did a presentation with Brian Stutland, and he threw I definitely want to give him credit on this. VXX is based on an underlying index, and there's actually index prices that go back for the index before VXX came out, and VXX, if it had been around in 2008, actually would have been up 122% in 2008. So the next time we have a market like 2008 or a market where we have high volatility, VXX is going to do what it was constructed to do.
Wow, that's a tremendous stat on that one. Okay, thank you very much, Russell. For more on Russell, you can check out him on the blog for CBOE.com.
For more of Jill Malandrino's plays for trading spikes in market activity, visit optionsprofits.com.